The U.S. housing market is sending a confusing, even alarming message right now. Sales are down, inventory is up, mortgage rates are still hovering right around 7%, and yet home prices just hit a new all-time high. How is that even possible? Sydney Lake of Fortune magazine recently summed it up with this warning. If you thought the housing market was bad enough, buckle up. So why the dramatic tone? Because despite widespread affordability issues and sluggish demand, the forces behind the housing market are more unstable than they look. Mortgage rates are pinning down both buyers and sellers. Builders are slowing down construction. And prices, they're going up, but not because the market is strong. In fact, it's the opposite. We're seeing what looks like a frozen market being held together by a very narrow band of wealthy buyers. In this video, we're going to unpack the full story behind these mixed signals. What's happening on the ground, what's driving these weird pricing trends, and what the experts are forecasting for the months ahead. And yes, we're going to break down exactly why Fortune told us to buckle up. So let's dive right in. Let's start with what the hard data is telling us. Home sales are slowing. According to the U.S. Census Bureau, new single-family home sales in June of 2025 hit a seasonally adjusted annual rate of 627,000. That's only a 0.6% uptick from May, but 6.6% lower than this time last year. Ashley Lutz wrote in Fortune, the U.S. housing market is experiencing a slowdown in new single-family home sales, while inventory and supply have increased and prices are declining. And that inventory, it's growing fast. At the end of June, there were 511,000 new homes for sale, a 1.2% increase from May, and an 8.5% increase from June of 2024. And they're sitting there longer. Supply of homes relative to the sales rate is now at 9.8 months. That high month supply figure suggests a slowing market, one where supply is now outpacing demand. And yet, despite more homes sitting on the market, prices are barely budging. Lutz reports that the median home sales price for new homes in June of 2025 was $401,800, down 4.9% from May of 2025 and 2.9% from a year ago. The average sales price was $501,000, down from the previous month, but slightly higher than a year ago. This suggests that home prices are finally feeling some pressure from rising inventory and declining demand. You might expect that to help buyers, but here's the twist. Affordability still hasn't improved much. Buyers are still looking at high mortgage rates and economic uncertainty. In fact, many would-be home purchasers are simply opting to stay put and make some modest home improvements instead. Lutz writes, concerns about the economy and job security mean many would-be new purchasers are opting to make do with modest home improvements instead. That's a sign of something deeper: weakening buyer confidence. Now, what about existing home sales? Laura Wamsley wrote in NPR, the median price for an existing home sold last month was $435,300, besting the previous record set in June of 2024. But even though prices hit a record, sales of existing homes actually dropped. Sales in June decreased 2.7% from a month earlier and were at a 9-month low, seasonally adjusted, NPR. So now we're seeing both new homes and existing home sales fall. This is why Fortune said to buckle up. Not because things are heating up, but because they're cooling down in a very unsettling way. To keep sales from completely collapsing, builders are pulling out all the stops. Lance Lambert of Resi Club reports that Lennar is spending the equivalent of 13.3% of final sales price on incentives like mortgage rate buydowns. For context, during the pandemic boom, that figure was like 1.5%. In a normal year, maybe 5 to 6%. So that means that these incentives have gone from bonus perks to must-haves just to get deals done. And even with all these incentives, many builders are pulling back. The U.S. Census Bureau reports that starts of single-family homes hit an 11-month low in June, while permits for new construction dropped to more than a 2-year low. So what's slowing them down? That drop in activity is partly because building costs are rising, and labor is harder to find. Home builders will continue to face higher costs due to tariffs and a reduced labor force because of fewer immigrants and more deportations. Oxford Economics. Let me pause and explain. Oxford Economics is one of the world's most trusted economic forecasting firms. They advise Fortune 500 companies, central banks, and governments worldwide. So when they sound the alarm, people listen. They say the combination of rising costs, shrinking labor pools, and mounting inventory is putting pressure on builders. And it's why the housing starts are falling when we desperately need more new homes. The new home market is also being challenged, with builders continuing to offer incentives, including price cuts, in an effort to move unsold inventory. Matthew Martin, Oxford Economics. So even with rising inventory, builder pullback, and nervous buyers, the market has one more surprise. Here's the twist. Despite all of this, home prices are still climbing. Mortgage rates are still near 7%, and home prices are 55% higher than they were at the beginning of 2020, according to the Case-Shiller U.S. National Home Price Index. Wamsley from NPR writes, the median price for an existing home sold last month was $435,300, besting the previous record set in June of 2024. So how can prices rise when both new and existing home sales are both down? Because this market is being driven by wealth. Today's housing market is really haves and have-nots. Jessica Lautz, the deputy chief economist for the National Association of Realtors. She explains, those who have housing equity can make housing trades right now. Many of them are doing so even with an all-cash purchase. And they are. In fact, nearly 1 in 3 buyers, almost 29% last month, paid all cash. Lautz reports that homes above $1 million saw the biggest sales spike last month, rising 14% over a year earlier. Meanwhile, first-time buyers are being completely squeezed out. It is pricing out buyers, Lautz said. They simply can't compete with all-cash, equity-rich buyers. The result? A two-speed market. One part is frozen, the other is red hot, if you have money. Another reason this market feels stuck is the lock-in effect. People who have lower interest rate mortgages are just not willing to make this move right now unless they have a lot of housing equity. Jessica Lautz, NAR. And if rates do drop, a lot of people who have been pushed to the sidelines are gonna come back in. And that could trigger a new wave of demand without enough supply to meet it. In other words, any improvement in affordability could actually lead to more competition and higher prices. It's especially hard for first-time buyers to get in. More demand without more inventory just restarts the affordability spiral and exacerbates the affordability crisis. So where do we go from here? Let's wrap this up with where the experts think we're going to go next. The supply of existing homes for sale is approaching pre-pandemic levels, but affordability challenges are keeping buyers sidelined. Matthew Martin, Oxford Economics. Substantial improvement is unlikely until mortgage rates and/or prices ease. Lawrence Werther and Brandon Stewart, Daiwa Capital. Lawrence Yoon from the National Association of Realtors says, multiple years of undersupply are driving the record high home price. Home construction continues to lag population growth. And Daniel Hale at Realtor.com adds, we still don't have an abundance of homes that are affordable to low and moderate income households. And even though we're seeing more homes on the market, Hale says the progress has been concentrated in the Midwest and the South. But in many coastal metros and high-demand areas like California, New York, or parts of the DC region, prices remain stubbornly high. So while some buyers are catching a break in places like the Midwest, others are still forcing bidding wars, and affordability barriers haven't even budged. Where I am here in the DMV, for example, which by the way is DC, Montgomery County, Maryland, and Northern Virginia, inventory is rising, but prices are still high, and competition hasn't gone away in the most desirable neighborhoods. It is not uncommon for homes that are priced right and show well to still sell with multiple offers and escalating prices. The only difference now compared to the previous market is that we are seeing a lot more home inspections and negotiations even with the higher prices. So that is a good thing. And if you're overpriced or your house doesn't show well, that is the kiss of death in this very fickle market. You will start to chase the market with price reductions until a buyer finally sees the value. So what's the final takeaway? Oxford Economics believes we will avoid a full-blown recession this year. But the real test for the economy is just beginning. Matthew Martin, Oxford Economics. And while they predict that home price growth will slow, slower home price growth may provide a floor beneath sales, says Martin, but only if the labor market holds up. This is a market divided. Wealthy, equity-rich cash buyers are still moving. First-time and middle-income buyers are stuck. Builders are slashing prices, but slowing construction. And policy changes haven't yet unlocked true affordability. The biggest question isn't just what rates will do, it's whether housing itself will start serving more than just the top of the market. This market isn't broken, it's just serving fewer people than ever before. If you guys missed my last video, my last housing market update, definitely check it out because we make some pretty interesting comparisons between 2008 and today. Thanks for watching. I do appreciate it, and I'll see you in the next video. Bye!